Did you miss Friday's historic market recovery while millions of retail investors were sitting on the sidelines? Panicked by terrifying geopolitical headlines, the Indian stock market pulled off its most explosive single-day comeback of the entire year. The Sensex skyrocketed an insane 1,695 points, and the Nifty 50 surged a massive 2%, closing strong at 23,622. But if you think you missed the bus, wake up. The real structural game starts tomorrow morning at 9:15 a.m. A historic, absolute game-changing macro shift triggered over the weekend, and it is about to act as pure rocket fuel for Indian equities. The single biggest question on every trader's mind tonight is Nifty hitting 24,000 this week? In this video, we are breaking down the exact global trigger that changed the market dynamics overnight, the three sectors primed to explode tomorrow morning, and the crucial technical options data you absolutely must know before the opening bell. Let's get straight into it. So what exactly changed that completely blindsided the market bears? It all comes down to two words: crude oil. For the past few weeks, the heavy shadow of an escalating US-Iran conflict kept global markets on edge, dragging the Nifty down to a stressful weekly low of 23,161. But the entire narrative flipped on its head when US President Donald Trump declared that a peace deal with Iran is nearly complete, officially calling off planned military strikes. The moment that geopolitical risk evaporated, global oil markets reacted with absolute violence. Brent crude collapsed by nearly 4%, crashing down toward $86.78 a barrel. Now, why is this an absolute goldmine for India? Remember, India imports more than 80% of its entire crude oil requirements. When oil prices crash, our national import bills shrink, our fiscal deficit narrows, the pressure on the rupee eases, and corporate profit margins instantly get a massive booster shot. Cheap oil is quite literally a shot of adrenaline directly into the heart of the Indian economy. With Wall Street and global markets closing in a massive risk-on mood on Friday night, the runway is flawlessly cleared for a bullish follow-up session on Dalal Street tomorrow. Smart institutional money isn't waiting around. It is already moving aggressively into specific sectors that directly benefit from lower oil prices. If you want to play this rally intelligently, keep your eyes glued to these three pockets tomorrow morning. First up, aviation and paint stocks. Raw material costs for paint companies are directly tied to crude derivatives, while aviation turbine fuel makes up the absolute majority of an airline's running expenses. Look at how Interglobe Aviation, ticker symbol Indigo, and market giants like Asian Paints reacted on Friday. They are prime candidates for massive sustained short covering and heavy fresh momentum this week. Second, banking and heavyweight financials. The financial sector makes up over 35% of the total Nifty weight, and it provided the heavy lifting for Friday's rescue. HDFC Bank climbed to fresh multi-week highs, and Bajaj Finance led the charge, surging an impressive 5.5% in a single day. If the Bank Nifty index, which closed strong at 56,814, breaks past the crucial 57,000 mark tomorrow, it will single-handedly drag the broader market upward. Third, capital goods and mega infrastructure. Infrastructure giant Larsen & Toubro crossed the historic 4,000 rupee mark for the first time ever on Friday. Lower energy and transportation costs mean much better project execution margins, making capital goods absolute structural winners for the week ahead. Now let's look directly at the charts to build your bulletproof game plan for Monday. Nifty ended the week beautifully at 23,622, closing right near its absolute daily high. More importantly, the June futures settled at a massive premium at 23,714, showing that institutional traders are aggressively holding onto their long positions over the weekend. Look at the options data for this week's upcoming expiry. The 23,500 put option has accumulated massive open interest, creating a heavy, solid floor of support. This means as long as Nifty holds above the 23,300 to 23,500 zone, the bears are completely trapped, and the trading bias remains firmly buy on dips. On the upside, the largest concentration of call sellers, the people betting the market won't rise, sits right at the 24,000 mark with over 1 crore active contracts. Tomorrow, if Nifty opens with a gap up and comfortably sustains above 23,800, it is going to trigger a violent panic-fueled short covering rally. Those call writers will be forced to buy back their positions to cut their losses, which could easily catapult Nifty straight to 24,000 and potentially toward 24,500 much faster than the retail public expects. The macro momentum is clearly back with the bulls, but disciplined risk management is always your best friend. Do not chase random high-risk penny stocks blindly. Stick to the high-quality sectors with strong corporate earnings and clear global tailwinds. What do you think? Will Nifty cross 24,000 by this Thursday's derivative expiry? Drop your exact target price in the comments below. Smash that like button if you found this breakdown useful, and subscribe right now for your daily market edge. I'll see you in the morning pre-market report. This video is for educational purposes only. Please consult a certified financial advisor before making investment decisions.